Home prices are at or near record highs. The stock market is at or near record highs, and people are itching to use those stock market gains or their home equity. There's that constant itch to do something. Should I take out a 401k loan for home renovation, or should I take out a home equity line of credit or a HELOC to buy my first rental property? If I had a penny for every time someone asked that second question, I would have a full dollar by now. People talk about HELOCs so casually, rarely mentioning the risk of taking on debt, especially when it involves putting your house at risk. And I say this as someone who has plenty of real estate debt. There is risk with debt, and there's risk with taking out a HELOC. And 9 out of 10 times, a HELOC cannot be taken on an investment property. So for the most part, a HELOC is usually on your primary residence. Keep this in mind as we go through this video. The first problem with the HELOC is that your lender can freeze your HELOC at any time. When you sign the HELOC agreement, you'll find clause that lets the lender limit access to your credit line, speed up your repayment schedule, or even cancel the HELOC entirely. This means that you could lose access to your home equity when you need it the most. And you might not have necessarily done anything wrong or missed the payment to trigger this. Although each lender's contract might have slightly different terms, common reasons for suspending or reducing your credit line includes the value of your home drops significantly below its value when you first took out the HELOC. We all saw this in 2008. Secondly, if the lender thinks that you might not be able to meet your repayment obligations due to major changes in your financial situation, they could cancel or freeze your line of credit. This can happen to anyone, really. Nowadays, bank treats HELOCs just like they would treat a credit card, where they closely monitor the homeowner's overall credit management. They might flag accounts for issues such as late payments or poor credit history, even if the HELOC payments were made on time. Lenders could reduce or close your credit line if your debt to income ratio changes. For instance, if your income drops or if they see that your credit is worsening. Factors like these affecting your HELOC are beyond your control, especially the changes in your home value. When the housing market is strong, home prices can quickly rise, giving homeowners what might seem like free equity. This makes it tempting to tap into that equity. However, if the market turns and the home values drop, your lender might reduce or cut off your borrowing ability altogether. Weakness in the housing market can easily spur lenders to change the original terms of a HELOC in a way that they can't do with traditional mortgages. I was reading an article from 2008 about when many people had their HELOCs frozen, and this particular section of the article stands out. Banks did not spend much time cutting the HELOC limits. It also notes that limits were reduced for new customers and progressively for existing ones. I think you get the gist. Now, the factor that is in your control is making regular HELOC payments. If you miss a mortgage payment, your lender can foreclose on your property. A HELOC is similar in that your home serves as collateral. If you don't stick to your repayment terms, you could face risk of foreclosure. Usually, lenders will work with you if you miss a payment or two, but don't forget that legally, they can kick you out of your house if you miss even one HELOC payment. Now, you might be saying that these are extreme cases. Things like this rarely happen in real life. That's where I disagree. This happens more often than you think. In one of my posts on Facebook about HELOCs, this is one of the comments. They lost their home and learned a huge lesson not to include their primary residence. As I've said plenty of times in the past, business and personal finances should be separate. And with a HELOC, you're combining the two. The other big issue with a HELOC is that rates are adjustable. Not for all HELOCs, but for the most part, rates are adjustable. That is, they can rise and fall with the benchmark rate, usually the Fed's fund rate, plus a margin set by the lender. Interest rates are currently around 6%, and based on my educated guess, rates are likely to go down or stay where they are. So if you get a HELOC now, your variable rate could decrease. However, keep in mind that this is just an educated guess. The HELOC drop period lasts for 10 years, and I can't say for certain what the rates will be in the future. So you won't know exactly what interest rates you'll be paying 5, 10, or even 15 years from now. So for example, if you have a HELOC balance of $50,000 and your repayment period is 10 years, your payments can change from $530 to $606 if rates went from 5% to 8%. And to be fair, that's not an awful lot, and the chances of a 3% swing are slim. But if you're like me and you dislike uncertainty, a HELOC is probably not for you. Another thing that you'll notice on this calculator is that the payments during the draw period and the repayment period. Payments at the end of the draw period are steep. During the draw period of a HELOC, your monthly payment is just the interest. This period is when you can freely withdraw the funds. Once the draw period ends, your payments will change. You'll either start paying both the principal and the interest over a set period of time or face a balloon payment. where the full balance is due at once. If you can't make the new payments or the balloon payment, you risk foreclosure. Now, does it hurt to open a HELOC? No, you could open one. And if you are familiar with HELOCs, you know that you don't get charged an interest until you actually use the HELOC. It could just be sitting there as an emergency fund or your fifth or your sixth line of defense that you never really use. And full disclaimer, I do have a HELOC on my primary residence. It did not cost me anything to open the HELOC, and the drop period should be coming to an end. I've never really used it, and I don't plan on using it either. Then another common question is whether it's smart to pay off your credit cards using a home equity line of credit. In theory, it sounds really good, right? Because a HELOC has an interest rate of 6 to 7%, while the credit card is charging you 20 to 24%. But before you do this, remember you're switching from an unsecured debt, which is a credit card, to a secure debt, which is a HELOC. And for the 100th time, a HELOC uses your home as collateral. This is why it is called a secure debt. And before you take this route, you need to be honest with yourself, and you need to ask yourself what led you to have so much credit card debt in the first place. If it was due to poor financial habits, remember that this time your house is on the line. Whether or not you should use a HELOC to pay off a credit card is for you to decide. If you've watched it this far, you can tell that I'm cautious about recommending it. That said, it might be a sensible choice in maybe a handful of situations. One of my close friends and a mentor bought his first rental property using a HELOC, and he had a 4% interest on it. Now he owns 8 apartment buildings. I asked him, knowing what he knows now, would he still recommend using a HELOC if someone is wanting to get into real estate? He said that a HELOC is definitely a useful strategy, but it has to be used with extreme discipline, which most people don't have. Things can go wrong and things do go wrong, so you have to be prepared for the worst case scenario. He did not say no, but again, it's not something that I want to recommend or I want to use. I prefer not to put my primary residence at risk. I've refinanced my investment properties and I've taken out equity loans multiple times, but I've always kept my primary residence separate from business. When talking about HELOCs, I always like to go back to 2008. During the housing boom in the early 2000s, home prices were rising rapidly, and many homeowners felt like they were sitting on a gold mine of equity. Lenders who were eager to capitalize on the housing frenzy made it easy for people to tap into that equity through HELOC. At the time, HELOCs were marketed as a way to access free money. Homeowners were encouraged to borrow against their homes to fund everything from home improvements to vacations or even to buy second properties. But as we know now that the surge in home prices wasn't sustainable. In 2006 and 2007, cracks began to appear in the housing market. Home values started to decline, and as a result, many homeowners found themselves underwater, which means they owed more on their mortgage and the HELOC than their homes were worth. By 2008, when the housing market fully collapsed, it triggered a wave of financial chaos. HELOCs played a significant role in this crisis for a few reasons. First, homeowners who had borrowed heavily against their homes suddenly had no way to repay their debt because their homes were no longer worth what they once were. At the same time, banks and lenders started to panic. As home values plummeted, lenders began freezing or canceling HELOCs altogether. Even borrowers who had never missed a payment found their credit lines suddenly cut off, leaving them with fewer options in an already dire financial situation. And why did lenders freeze HELOCs? When the value of home, the collateral for a HELOC, dropped, the lenders were no longer comfortable letting borrowers access that equity. They feared that in an event of a default, they wouldn't be able to recover their losses by selling the home. But for borrowers, these freezes came as a shock. Many relied heavily on their HELOCs as a safety net or a way to fund their ongoing projects. The result was a vicious cycle. After talking to so many of you on Facebook, reading stories, the good, the bad, the ugly, I think there are better ways to use debt more cautiously. That's my personal rule, and knowing what I know now, I would recommend and I would suggest that you do the same.